This is the Smart Beach Investor Podcast, where we explore how investors leverage real estate at the beach to live big lives and build their personal wealth. If you are an investor at the beach or you want to be, you found the right place. Enjoy today's show and be sure to subscribe to the podcast so you never miss an episode of the Smart Beach Investor.
Welcome to the Smart Beach Investor. I'm glad you're here. I am fired up that you are here. So today we're going to talk about the real estate market here on the Emerald Coast in Panama City, and specifically about how the market cycles and why that is important to you as an owner of real estate here, as an investment, or even as a second home, or even a primary for that matter, because markets cycle. All markets cycle. Matter of fact, Gary Keller of Keller Williams fame says generally real estate is cyclical. You have to buy in a way that lets you afford the cycles. And you have to know where you are in the cycle. So we're going to talk about that. All right. We're also going to talk about why markets cycle and what you can do about it. And we'll give you some action items to do at the end, depending on where you're at in your cycle. All right. So that's what we're going to talk about. I have Katie Luz here today. She works with Keller Williams Realty's At the Beach team. And full disclosure, that is my real estate team. She is the lead coordinator on that group. How you doing there, Katie?
I'm good. Thank you for having me, Don. I'm excited to be here.
Absolutely. And the cool thing about Katie, she and her husband are about to become investors. They're looking at buying their first investment property, a condo, I believe, is what you're looking for. Is that right, Katie?
That's right. I am scared, to be honest with you. I've never done anything like this before, but with all the knowledge that we have, I'm going to feel way more confident about doing it.
Yep. You got to know this stuff as an investor if you're going to be a smart beach investor for sure. Okay. So let's get started. Let's talk about the first one, right? Markets and their cycles. To every market cycle, there are 4 stages. You have recovery, expansion, hypersupply, and recession. Okay. And that sounds like a lot. And we're going to take a look at each of them individually. And I have a graph here that we're looking at. If you're listening to it on the podcast, you won't be able to see it, but I'll try to point it out as best I can. If you want to see the graph, go ahead to smartbeachinvestor.com, or you can go to YouTube Smart Beach Investor as well, and you'll see the graphs there. And we have graphs going back to 1994 showing the median sales price for each year from 94 through 2021, at least through November of this year. And that's for the Emerald Coast, the Destin area, homes and condos, as well as Panama City Beach, homes and condos. And you'll be able to see clearly these market cycles. It's pretty amazing. But let's talk about them real quick. The first stage in the cycle that we're going to discuss is the recovery cycle or stage. And that would go back, if you want to go back to, say, 1994, 95, 96, somewhere around there, where the market was just getting started, or maybe even if you looked at the graph at 2011, 2012, around there, after the market tanked back in the Great Recession there, you'll see that prices have bottomed out, and now they're starting to climb again, to come out. And in this cycle, the recovery stage of the cycle, you'll see rents and sales prices start to moderate, right? They stop dropping, sales prices do, and rental prices. They start to hold and maybe even start going up a little bit. You see lending start to loosen a little bit here. In the recessionary stage, you see lending really tighten up. When we get to the recovery stage, things start to loosen up a little bit. People start getting more access to money. Demand ticks up. Folks that were hanging on, probably getting ready to sell. This is the recovery stage of each market. And then the recovery rolls into expansion. And again, I know you can't see it, but expansion occurred going back in time in 1999, 2000, 2002, right around there, where back then the market started to take off a little bit, and you started to see more condos come on the market, builders getting into the game, a lot more homes being built, that kind of thing. If you take it back to a more recent time, if you look at maybe 2014, 15, 16, you see a lot of prices starting to climb up, right? People are getting loans. Things are happening. It's pretty exciting. And then you jump into hyper supply. That's the third stage of every real estate cycle. This is a frenzy period, right? We saw this back in the day, 04, 05, when prices would just jump to the moon. I remember that's about when I started real estate. And I remember talking to folks, and we'd get a call. The phone would ring off the hook. This is before cell phones and all that, right? The phone would ring off the hook. And it'd be an agent calling up, hey, is such and such still listed for sale? We're like, yeah, so far, yep. Cool. I'm sending over an offer. What's your fax number, right? That was back when we had faxes. You didn't email or do anything. You faxed or FedExed it. And we're like, all right, here's a fax number. Okay, just wait right there. I'm going to send it over right now. I want you to wait till, and you'd hear that beeping and whatever noise of the fax, right? And then sure enough, another one would come through. But in the meantime, the phone rings. It's another buyer agent. Hey, is that property still for sale? Well, we're expecting some offers. I'm sending a fax over right now, offer over the fax. Take a look. And sure enough, they just grind out offer after offer, multiple offers, bidding wars. And we would just figure out what the highest price is and take that deal. It was a frenzy. I mean, it was crazy. We had sellers praying that the deals would fall through, right? Just, hey, if this thing falls through, no big deal, because I'm going to sell for 20 grand more tomorrow. It was amazing. And it's weird. It's weird, you guys, because I look at now, at least last summer, last spring, we had multiple offers. We had bidding wars. We had buyers giving up, waiving all their rights, right? No inspection, no contingencies, no nothing, right? Bidding over asking price. That is a frenzy. That is a frenzy. And it feels and looks and sounds a lot like it did back in 04, 05, 06, right? When the market was crazy. So you got to be ready, because we've seen it go from recovery up through expansion. And I wonder if we're now in the hyper supply frenzy stage. And will it carry on to 2022? Maybe. We are seeing some chinks in the armor, though. We are seeing prices kind of stabilize a little bit, list prices. They're still going up, I guess, as we look at that. But for the most part, days on market are getting a little bit longer. Buyers are taking a pause. I know we talked about that in an earlier podcast as well. But it's getting a little bit soft, a little bit spongy out there right now. But I expect 2022 to probably be a pretty big year. But the fourth stage of every market cycle is recession. Recession is just simply too much supply. And when prices start to drop, right? You see rents and prices drop, slow at first. Then they just wholesale fallout. You see the foreclosures, short sales everywhere, right? All that stuff seems to fall apart. Lenders stop lending. It gets really hard to get money.
So I probably need to be ready to go sooner than later.
Well, yeah, probably. Now, it really comes down to, from you, since you're just starting, and we're going to talk about personal cycles here pretty soon. But yeah, as somebody who's starting, I would get your money together, because money's cheap right now. We know money's cheap right now. Inventory's a little bit tight still, which is a little bit of a headache, but money's cheap, and you're going to be in this for 20 years at least. So
yeah,
you can buy anything anywhere and you'll be fine. You don't have to worry about that, because you got a long time horizon. But yeah, definitely get your money together, because we're already seeing that the cost of mortgages is starting to creep a little bit.
So get
right
my
now.
ducks in a row, be able to pull that trigger when I'm ready.
Yeah, if you're going to be smart about it, I would. Now, there's some talk about maybe, if the market drops a little bit, and it's hard to tell if it's going to drop and when it's going to drop. It's very hard to time the market. So be a little bit careful there. But I do fear that a recession is coming at some point. The market, trees don't grow to the sky. That's a known saying among investors. And we've been growing. If you look at the chart, prices have jumped a lot in the last 2 years. I think I looked, condos are up about 31% in the last 2 years, something like that. Just massive number. Great time for those folks that bought it if they're going to sell and get out. I mean, they can make a killing on it, no doubt. But the recession stage, the fourth, you got recovery, expansion, hyper supply, which is kind of where we're at right now with multiple offers, crazy stuff going on, followed by recession. And it's coming, folks, at some point, just a matter of when. Now, I scratch my head a little bit because couple things have to happen. Supply has to go up, right? If you have very little supply, it's hard for prices to come down because sellers know they don't have to give on price. There's no competition. So that's going on. Money, while it's gone up a little bit, is still fairly cheap. Okay. So that's a good thing. The one thing that scares me a lot, that should scare everybody, because I hear it. We hear it everywhere. This time is different, right? This time is different, right? John Templeton said the four most dangerous words in investing are "this time is different." And it's hard to argue with that. It is different, but it's also the same because trees don't grow to the sky. And really what you got to be worried about is the stuff you don't see. Nobody saw a pandemic, right? That came out of nowhere. Nobody saw that. Nobody saw the total collapse back in 04, 05. I mean, they did. They knew it was coming, but they didn't know we're going to lose 60% of market value. We didn't know the bank and the financial systems were going to collapse. Nobody saw that coming, right? So it's what you can't see that scares us. And I look at that graph, and it looks like a market that's getting ready to turn. All right. Now, how far down it drops, who knows? Who knows? So why do real estate markets cycle? Let's talk about that for a minute, right? Ray Brown said the best time to buy a house is always 5 years ago, right? Or in the next expansion period. I would argue that. So the reason why markets cycle, one, affordability goes away. Things just get too expensive. They don't make sense, right? The rent don't keep up with the cost to carry it, right? You start operating in the red. Back in the day in 04, 05, people didn't care about rental income. They're getting so much appreciation. They're buying on appreciation only. It was weird, scary weird. But affordability goes away. That'll cause a market to turn. Or the flip is affordability gets good, like in a recovering market where banks start lending again. So that comes into play. Right now, though, we're still seeing affordability is still pretty strong. The second thing that causes markets to turn, supply and demand, right? Simple supply and demand. Inventory starts to grow. And like we were talking about a minute ago, inventory is still pretty tight right now, very tight. But geez Louise, I just drove over to Panama City. We're doing a condo renovation. We're putting some new furniture and stuff in there. And the amount of new construction between here, Destin, and Panama City is amazing. I haven't been down that way in a while. It's absolutely amazing to see all the sticks and bricks going up, a lot of commercial stuff, but there's still a lot of homes being built over there too. So we might start seeing some inventory. Demand is still pretty strong. However, we are seeing a little bit of a pause in demand. Buyers just kind of taking a time out. We had a very intense spring and summer season where a lot of buyers going in over asking price, not even getting a response, not even getting a no, just a silence. Sorry, not good enough. So that's still an issue. But supply and demand is going to change at some point. And the third main reason why markets turn, simple government policy. The government gets involved, right? Back in the day, Dodd-Frank came into being, which said a couple senators came out and said everybody deserves a house. So they made it really easy to get loans, right? Stated income, no doc loans. You didn't have to prove any income. You didn't have to bring in your tax reports or anything like that. You just go in and tell them how much you earn, right? They ask you how much you want to borrow, and you tell them, I don't know, how much can I get? And they basically say, well, if it's 600, you got to earn 600. And you wrote 600 on your application and they gave you money. So in addition to Dodd-Frank back in the day when they made sure everybody got a loan, that blew it up. We had buyers everywhere that couldn't afford things and they didn't care about the basic fundamentals of investing. Also, capital gains comes into play, right? And 1031 exchanges, as you all know, right? If you own property as an investment, you're keenly aware of 1031 exchanges. These are big issues in the new Biden Build Back Better policies. There's a lot of stuff that's going to impact what's going on from an investing standpoint. So that could definitely change our market. Okay, so those are the reasons. Three basic reasons: affordability goes away, supply and demand changes, and then government policy. Those are the main reasons why market cycle. So now, what I want to do is let's talk about how to protect your equity that you've earned, and or how to leverage the cycles based on where you're at as an owner. Right. Or Katie, where you're at as a new, going to be a new owner in yours. And really what it comes down to is what I tell folks is you got to figure out who you are and where you are in terms of your own personal cycle. And let me just see where, Katie, I think you're starting, right? There's four basic places you can be from my standpoint. One, you're going to be a long-term holder. That means you're going to own this property longer than 5 years.
Absolutely.
That's you, right?
Yep. Mm-hmm.
Okay, so if you're going to own longer than 5 years, you can ride out any change in the market.
An up or a down.
An up or a down. You can ride the up, maybe even buy in if you feel the market's low and you're in an expanding market or even a hyper market. You can still buy in because you got the time.
Mm-hmm.
Right?
Yeah.
So that's a long-term hold, 5 years or longer, which is a great place to be because there's no pressure. You just sit back. The second one is if you're a short-term owner, meaning you're going to sell in the next 5 years, 1, 2, 3, 4, 5 years, right? And I think you see a lot of that with our clients. Isn't that what you're seeing?
Yeah, and I think that's a little bit more risky, and I'm not quite there yet. That's why I would do like the long run for me personally, because I'm just stepping my little big toe into this, Right. So I'm just starting. So I'm more looking at it in the long run, not like a quick flip investment type thing.
The longer the hold, the less risk there is. And as you can see over time, if you bought in 94 and you still owned it now, you probably tripled your money. All right. It's longer the better. But if you're 5 years or less, what we recommend to everyone is sell. Get out now. Get out because here's the reason why. It's real simple. We know exactly what's going on. We know where the prices are. We know what the buyer demand is. We know what you can get out with. All right. Those are pretty easy to see right here, right now. A year from now, not so much, a little foggier. 2 years, getting foggy, right? You don't know. Somebody could fly an airplane into a building tomorrow, blow this whole thing up, right? Biden could come out tomorrow and pass some law, executive order, whatever, says if you own a investment property, you owe $1 gazillion in debt. Any number of things can happen, right? So if you're not going to own very long, leverage what we know and get out now. Mitigate your risk, okay? If you're on the buyer side, let's talk about that. Like, Katie, you're a buyer. If you're a long-term, if you're going to buy and own long-term, buy. Rates are cheap right now. I mean, you can get an unbelievable cost of money right now. It's unbelievable. So you can buy an investment. You can afford to pay more than you might otherwise because the money's so cheap. It's a great thing, especially if you're going to spread it out over 30 years or 20 years, whatever number of years. You get a great deal on your money right now. And again, if you're long-term, who cares? Watch the market go up and down, as you can see on these cycles. If you're a short-term buyer, a flipper, like you were saying earlier, there is inherent risk in being a flipper, okay? Now, it works. If you were buying property over the last 5 or 6 years, you could buy and flip the very next year and likely make money, a lot of money. And folks have been doing that harder because the sellers have been hanging on. But for the most part, there are deals out there. And there's always folks that need to sell, divorce, death, whatever. They need to get out fast. And you might be able to pick up a deal. It's just a scary game to play when you work on such short timelines. Now, the big upside is if it works big. But yeah, that's hard. Let's talk about when you're a long-term holder, though, because I think most folks are long-term holders. if you're going to be a long-term holder, 5 years or longer, a couple things we recommend that you do. First is you want to max out your rental income. Okay. Let's make sure you're capturing as much as you possibly can from your property. Okay. And there's a bunch of ways that you can do that. Upgrade it, update it, get a better property manager, watch closer on your pricing, things like that. But make sure you max out. If you're going to be a long-term holder, max out that rental income, because someday when you do sell it, we'll sell it faster for more money. Simple as that. The second thing you want to do is make sure you're going to max out your equity. A lot of people that have owned for any period of time here have massive amounts of equity in their property. And what's a lot of folks are doing right now are pulling out that equity either through a home equity line of credit, maybe on their primary home, and buying an investment property here at the beach.
That's exactly
what you're doing.
Yep, that's exactly what we're planning on doing as well. Yeah.
Okay, right? Because you're going to get a great rate.
Yep. And because we only bought in 2018 and we've already have so much equity in our primary home that we're grabbing it out, and now I'm going to do the investment thing with it.
Yeah, see that? So she bought her place in 2018, and she's got so much equity built up that she can pull the equity out, buy an investment property that's going to cash flow. Is that true?
That's
right. It's going to cost you nothing, right?
Yep.
Your checkbook remains the same today. There's no extra cost. Renters are going to pay the cost of your mortgage, your taxes, your insurance, all that stuff, right?
That's exactly why I was sold on it. I don't have to pull out my checkbook. I don't do anything. It's just moving it from one place to the other.
Right. And in 20, 30 years, whatever it is, your plan is somebody else will have paid for that condo, and that's your retirement, right?
Yep.
It's going to kick off $50,000, $60,000 a month now. 20 years from now, maybe 70, 80,000 a month.
That's our plan, and keep adding them.
And just add another property, once the equity. See, that's so smart. So smart. That's what folks should be doing, right? And then the other thing you're going to want to do, Katie, once you get going, or anybody who has that, is max out your tax advantages. Okay. When you own a property or when you buy it, you can do cost segregation. Make sure you talk to your accountant about this, right? You can do a cost segregation that will give you a massive tax credit back or deduction back, save you a ton of money. So if you buy a property for, say, I don't know, $400,000, you can probably through cost seg get back first year on depreciation and deductions from that, and talk to your accountant. I think somewhere around $30,000 or $40,000. That's money on top of what you're already getting.
Yeah. So is it best to put the property in an LLC?
Absolutely. Talk to your accountant about this.
But
I would definitely recommend you put it in an LLC.
Okay.
Okay. And trust, and a lot of that comes into estate planning. We'll talk about that in the future, but for sure. Yeah, those are three things you should do as a long-term holder. Anybody out there who's planning on owning 5 years or longer. And if you're thinking about buying, either flipping or adding, like Katie's doing, using that equity to cash out, give the folks over at the Beach Team a call. They're doing more, I think 250 transactions this year?
Yep.
Crushing, right? They're one of the leading groups here on the Emerald Coast, both Panama City and in Destin. Give those folks over there a call. They'll be happy to talk through all this with you. But it is an incredible time to be an owner of real estate and building wealth. You just need to know your cycles and where you're at. If you're 70 years old or 80 years old, you may not want to ride out this next downturn that's coming. You may decide that it's time to sell. Perfectly fine, perfectly cool. Maybe you're using your money or your investment, you're just waiting to sell because your kid's going to Harvard or they're getting married or you're retiring and you're going to do something else. That's cool, but we are in an expansion or hyper expanding market, which is followed by a recessionary period. So be careful if you don't have the time to ride that out. Call those folks over at the Beach Team, Keller Williams Realty's at the Beach Team. Let them tell you where you're at, and they'll watch the market for you. Like Katie, we'll watch the market for you. That's what we do. It's why people like you hire people like us, right? We watch the market because you don't want to get caught behind on this, right? You don't want to be selling in a down market. And if it turns, we'll watch and alert you. Hey, the market's got 6 months and down. You may want to pull on this one. You may want to jump out while you can. Or are you still comfortable with your strategy?
Yeah, I'm confident with everything that you guys have told me and stuff. And then I'm really excited. It's exciting times to do something like this. I've never thought I would be doing it. And here I am doing it. And I'm really excited about
So
it.
cool.
Yeah.
So cool. I love it. It's such a great time to build wealth. Just watch your cycles, the market cycle, as well as your own personal cycles. So if you want to take a look at where you are at in your cycle with your property, or if you're thinking about maybe using the equity that you have in that property or properties to buy more, build your wealth, give the folks over at Keller Williams Realty's At the Beach team a call. They'll help you out. They'll get you straight on this, okay? They can be reached at 850-654-3325. They'll be happy to help you. So there you are. It's a great time to be in real estate. And it's a wonderful time to build your wealth. So let's get after it, guys. Let's be smart beach investors.
Thanks for listening to the Smart Beach Investor Podcast, where we explore how investors leverage their real estate at the beach to live big lives and build their personal wealth. If you like what you heard, be sure to subscribe to the podcast so you never miss an episode of the Smart Beach Investor.